Hey everyone, what's going on? It's Jason here. Today we're going over GME, how GME went this past week. Also, some crazy news on FINRA finding Citadel and what I think is going to go on next week. If you could, make sure you guys hit the like button below. Not only does it help out the video, but it also helps out new people learn about GME and also get the information out. If you aren't a sub, make sure you guys hit the sub button and let's get right into it. If you're wondering what charting system I'm using, Webull, there's a link down in the description. You get 2 free stocks worth $1,800. Also get their tier 2 system right here for 3 months as well. As you can see here though, this last week has been a lots of ups and downs. It's been crazy this last week. On Monday, we did start out over $200 going in to market hours on Monday. As you can see though, we had a downturn throughout the week, all the way down to $112 at the lowest point, all the way back up to $218.86 on Friday, ending Friday at $181 going into the aftermarket. And ending aftermarket on Friday at $178. That part doesn't really matter too much. So as you can see, we had a crazy up day on Thursday. A good aftermarket, good pre-market, and then we kind of fell down from that high of $218.86. But again, overall on Friday, it wasn't a bad day. We were fighting against markets. You're fighting against the hedge funds. You're fighting against everything right now. The market is crazy right now. You have 10-year and 5-year treasury rate yields being nuts. We had the PCE numbers come out Friday, and that's one reason why last week we had this downturn in the market. Bigger commercial investors and hedge funds, aka suits, they like to pull money out of the market when these numbers are coming out, right? So that doesn't help us at all either on that end. And on top of that, you got this crazy, evergreen ship stuck in the canals in Egypt, not letting anything through. So it's just like you got this whole whirlwind of a mess going on right now in the market, and it could affect the market a little bit coming up this next week. But I honestly do expect this coming up week we do see a upturn in the market, and I think that there's also going to help out GME blast back up to maybe even $300 again. I don't know if you guys have seen that. This is a funny meme. It was on the wallstreetbets news Reddit section right here. It's funny as all get out. It says, when DFV and Ryan Cohen meet for the first time, this is the way. Like, what am I watching here, dude? I don't even know. I don't know what's going on there, man. But I hope it's that way if they ever do meet. I hope it literally is that reenactment right there. It could be. It's one of the most weird things I've ever seen. But again, one of the more funnier things I've seen as well. I had to show you that real quick though. Just get some good laughs, get you some good memes for the day. I know it's Saturday. Everybody's trying to take a rest from this crazy last week, the up, the down, then back up, and then the back down again on Friday. But I don't know if you guys seen this though. FINRA slaps $275,000 fine on Citadel Securities for reporting violations. What I imagine here is, obviously $275,000 isn't a lot of money to a company making billions of dollars and hundreds of millions of dollars every month. But hey, at least they got something right. But they definitely need to start upping these fines. Like, hey, slap them right here with a $275,000 fine real quick. That'll show them what to do next time. They won't do it again, even though they do it all the time. Oh God. But I'll read this out real quick. The Financial Industry Regulator Authority, FINRA, has fined market making and execution services provider Citadel Securities $275,000 for lapses in regulatory reporting. The self-regulatory body additionally issued a censure order against the company. Ooh. The official order is issued on Thursday detailed the Citadel Securities had multiple issues while reporting treasury transactions with the trade reporting compliance engine from July 2017 through October 2019. And see, like, I almost feel like even if they do get fined for what they did this year, it's going to be like 2025 before they get fined, or you know what I mean? Like, oh God. And what are they going to do? Get another $275,000 fine? Like, good Lord. The alleged specific violations of the company include incorrectly reporting internal transfers of treasury transactions when they were not reportable, failing to append the no remuneration indicator to trace reports for certain treasury transactions between the affiliates, and failing to include the correct contraparty type in its trace reports for certain affiliate transactions. With these reporting lapses, the market maker allegedly violated FINRA rules 6730 and 2010. Additionally, Citadel Securities violated the FINRA rules 3110A and B in 2010 as its supervisory system was not reasonably designed to achieve compliance with the trace reporting rules because it could only detect violations that would generate automatic alerts. Though Citadel Securities agreed to pay the penalty, it neither admitted nor denied the allegations. They never do, right? They're never going to say anything. Again, they get these small fines of $275,000, literally pennies in the bucket. Respondent hereby accepts and consents without admitting or denying the findings of solely for the purposes of this proceeding and any other proceeding brought by on or behalf FINRA, or to which FINRA is a party prior to hearing and without a jurisdiction of any issue of law or fact. The acceptance letter added. Meanwhile, FINRA was actually penalizing financial companies for reporting violations. Some settlements even reached millions of dollars. Most recently, it filed an independent broker dealer, LPL Financial's $6.5 million for failure in keeping records. Again, $6.5 million, again, compared to these, like LPL makes billions of dollars as well. It's a small bucket, like small little drops in the bucket. You know, when are they going to start upping these fines for these guys for like not reporting, two, making false reports, things like that? Like nothing's going to change until they start like having stricter regulations, right? On these companies, man, that just go in and do what they want with little, recourse to be done with them. Now, there was an official AMA with Dennis Keller, and he's the president and CEO of Better Markets, Fighters for Retailers. So this guy here obviously fights for the little guy, right? He wants to see regulations. He wants to see things like that happen. Hi, guys. I'm Dennis Keller, president and CEO of Better Markets. Some of you might know me from the recent testimonies from the House Financial Service Committee on GameStop, Citadel Securities, and payment for order flows. Thanks to all of you who cheered us on, which obviously we're all cheering him on, right? I have almost 2 decades experience in DC, including as a senior staffer in the U.S. Senate, and have seen firsthand how Wall Street is able to influence the policymaking progress. My colleagues and I at Better Markets work to fight against Wall Street interest and promote common sense reforms that make our financial markets more transparent and fair. Now, I think we all can agree on that. That needs to happen. I think we're kind of fighting for right now, right? Now, this guy here is asking questions. Again, this is questions, right? So the first question is, giving the D&D is the outline theory behind an FTD squeeze a realistic scenario, including the contraction and release of the pressure walls impacting share prices given the right market conditions? And what is the possibility of it existing in this case? 2, is it possible that the majority of recognized short squeezes since the 1981 stock borrower program, and especially since the adoption of Reg 203B, can it be tied to a collapsed form of an FTD squeeze, essentially attributing them not to the over-shorted position of the stock? Through this is certainly part of it, but rather to the continued borrowing to support the short position, creating FTDs at high enough levels to create pressure walls as undelivered short sold shares continue to not be delivered. This would mean that plenty of FTD squeezes are happening at various strengths around the market at any given point in time, and only when the market conditions are right, as outlined above. Would they become a short squeeze? However, in most cases, the spring is simply uncoiled over time as the short positions deliver their FTDs and cover their shorted positions back to manageable daily market levels. Now, we talked about this a lot, obviously. You do see a lot of short squeezes right now going on. A lot of people are looking at short squeezes, looking at companies they can short squeeze. So that's the reason why you do see a lot more short squeezes going on, right? AMC, GME, Cost. I mean, the list goes on. RTK, SKT. There's all kinds of them, right? There's tons of them, and more people are seeing that. And he is right here, right? That these springs, usually come in cold very slowly, and you see a kind of a slow updrift of the stock, and then it falls back down shortly after that in a very, very, soft squeeze. You know what I mean? And if there's a lot of people behind it pushing it, it could definitely squeeze. You see that right now going on more and more and more as more people are looking into different stocks, seeing different stocks that could squeeze, things like that. This guy here says, was great watching you during the hearing. What was your first reaction to find out about the editing done to the hearing upon release by the media? Well, first, thanks to the Redditor who spotted it and brought it to everyone's attention. I wasn't surprised. As I said in a press release we put out on this, CNBC is one-sided pro-Citadel and most of Wall Street. We did find it odd that they would do it to a video of congressional hearing, but they know their audience and don't like to offend / disappoint a big finance. Now, we go over this a lot in the channel, like obviously these bigger, these bigger channels, your Fox Business, your CNBC, saying that. I mean, obviously, man, let's be honest. I'm sure they're getting paid some money from these bigger hedges, from these bigger funds. Let's be honest. And they don't want to pee off anybody either, right? That's the reason why I don't get a lot of my news from those kind of sources, right? I do look to see every once in a while and click over there and see what they're talking about, right? And see what's going on. But I don't go over there and get most of my news. As you guys know, they did take and edit it out. A bunch of people did, right? It's not just CNBC. It was other places as well. They all showed about the same stuff. Pretty much they edited out a lot of questions that were harsh towards Citadel from Dennis Keller. He also says right here as well, Dennis Keller does, the biggest problem with the Citadels of the world is that they're unregulated in critical respects and are allowed to operate with little transparency, oversights, or accountability. For example, it should be subject at least to Reg SEI, but it is not. And the SEC has so far refused to apply Reg SCI to many market participants that it should be applied to. Citadel is also at the core of the fragmentation of our markets, which operates to the disadvantage of our retail investors, buy side, and the financial system. Hopefully, with the new leadership coming soon, some of that will change. Now, let's hope that changes, right? I know a lot of you guys, political-wise, I'm not going to get into politicals, but there is a good guy coming in to the SEC, the head of the SEC, called Gary Gensler, and a lot of people are very good proponents of him. And he's right here. Dennis Kelly even goes with that right here. Biden has almost confirmed the new head of the SEC is Gary Gensler, who was fantastic when he headed up the CFTC. We hope he's going to reinvigorate the SEC, prioritize retail investors and market protections. We're going to be pushing him to do so, and we'll be posting here in the future to keep you informed and maybe enlist your help to rule-making process to push back on Wall Street where it hurts when they are trying to bend the rules to help themselves in screwing retail investors. Now, I think we can all agree that we definitely need a lot more regulations in the market, especially against these bigger hedge funds. The suits have ruled the market for a very, very long time, since the beginning of the market. So I don't think that's going to change any, but hopefully get some regulations around it. And that can also help out the retail investor, maybe have a little bit more advantage than we have in the recent past. If you guys like this video, make sure you guys smack the like button below. If you're not a sub, hit that sub button. Also, remember, there's a Discord link down below. Make sure you guys join the Discord as well. I'd love to have you over 1,000 people in there right now. And there's a Patreon link down below if you guys want to be up on other plays and things like that and the private live streams. Make sure you guys hit that Patreon link. And I'll see you in the next video.